News from the Fed's March meeting, live coverage of the FOMC policy statement and interest rate decision, as well as Chairman Jerome Powell's press conference. Bank stocks tumble after Powell, Yellen say government won't back all deposits. Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen both stopped short of whatever it takes declarations regarding protecting customers' bank deposits should recent turmoil in the sector escalate further. In response to a question at his post-Federal Open Market Committee meeting press conference on Wednesday, Powell said that he couldn't promise to backstop all deposits, but that the Fed had other measures to prevent losses. "You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools," Powell said. "I think depositors should assume that their deposits are safe." In simultaneous testimony before a Senate committee on Wednesday, Yellen said that her department wasn't considering expanding Federal Deposit Insurance Corp. guarantees to all bank deposits, and that it wasn't yet the appropriate time to reconsider the $250,000 cap. For now, federal regulators are focused on stabilizing the U.S. financial system and boosting public confidence in banks, Yellen said. The pair of remarks immediately hit U.S. bank stocks. The SPDR S&P Bank Exchange Traded Fund, ticker KBE, was down more than 4% shortly before Wednesday's close, after being up slightly in the morning and down just 1% around 3 p.m. Nicholas Jasinski. Yellen says Treasury not considering expanding FDIC insurance limit. Treasury Secretary Janet Yellen told a Senate committee that she's not considering expanding the FDIC's insurance limit of $250,000. "This is not something we've looked at," she said. "This is not something we are considering." Yellen said that during a contagious bank run, the Treasury would likely pursue an exception that would permit the FDIC to protect all deposits. "This would be considered on a case-by-case basis," she told senators. Stocks turned lower on her remarks. Yellen's statement came as Federal Reserve Chairman Jerome Powell discussed the banking system in a separate news conference. Karishma Vanjani, disinflation is still underway, but there's more work to do, Powell says. Investors and economists seized on Federal Reserve Chairman Jerome Powell's remarks at February's press conference that the process of disinflation, a deceleration in the pace of inflation, had begun. On Wednesday, Powell said that the process was continuing, but that there was more work to be done to get inflation back toward the Fed's 2% target. "The story is pretty much the same," he said. Powell noted that inflation in prices for goods has been coming down for several months, while housing services disinflation was a matter of time, as new leases are signed. Those two categories together are responsible for 44% of the core personal consumption expenditures price index, the Fed's preferred inflation measure. It is the remaining 56% that remains stubbornly inflationary. Powell said that he is seeing less progress in the non-housing services elements of the PCE basket, which are closely tied to wages. Getting disinflation there may take some softening of consumer demand and labor market conditions, he said. Powell reiterated that he saw the risk of not doing enough to get inflation down as greater than potentially doing too much. If the central bank doesn't get inflation back in place, you can have a long series of years where inflation is high and volatile and it's hard to invest capital and for an economy to perform well, and we're trying to avoid that, Powell said. Nicholas Jasinski. Treasury's rally on rate increase. Treasury bonds were rallying, pushing yields down across the curve Wednesday afternoon, after the FOMC's announcement. The 10-year Treasury's yield was at 3.46%, down from the 3.603% it closed at on Tuesday. Bond yields and prices move inversely. Meanwhile, the 2-year Treasury's yield was at 3.93%, down from the 4.175% it closed at on Tuesday. The 2-year Treasury is closely tied to the terminal rate, or where short-term rates will be when the Fed finishes its rate tightening program. Christian Chan, Chief Investment Officer at AssetMark,
called the Fed's rate increase an accompanying statement, a fairly dovish signal.
The Fed's statement reads in part that some additional policy firming may be appropriate. Chan said he thinks the bond market is taking Powell at his word, expecting policy firming, as opposed to ongoing increasing of rates. The FOMC's statement also said that the U.S. banking system is sound and resilient, a reference to the banking crisis that began with the failure of Silicon Valley Bank earlier this month. Still, in his prepared remarks prior to his press conference Wednesday afternoon, Fed Chairman Jerome Powell said that inflation remains too high and the labor market continues to be very tight. That drop in yield for the 2-year note suggests the bond market is expecting the Fed will have to cut rates when a recession takes hold, though the timing is uncertain. Chan says that the Fed funds futures curve is shifting rapidly, especially after the recent banking turmoil. Even on Tuesday, he says, futures were anticipating a couple of rate increases in the next couple of months. As of Wednesday afternoon, he adds, the market was forecasting one more rate hike, the possibility of a second one, and then cuts as far as the eye can see. US 10-year Treasury Note BX, TMUBM USD 10YXTUP percent 3.471% 0.139 filled down pointing triangle. US 2-year Treasury Note BX, TMUBM USD 02YXTUP percent 3.989% 0.177 filled down pointing triangle. Lawrence C. Strauss SVB's failure was an outlier, Powell says. Fed will look into regulatory errors. Federal Reserve Chairman Jerome Powell called Silicon Valley Bank an outlier in his remarks on Wednesday, and said that the central bank was undergoing a review of its oversight of the bank. At a basic level, Silicon Valley Bank management failed badly, Powell said, including by not hedging risks in long-duration securities on its balance sheet, and then faced a rapid bank run.
The bank's troubles aren't a sign of wider failures to come in the U.S. banking system, he said.
The Fed is one of the U.S.'s main financial regulators and had oversight responsibility for Silicon Valley Bank. Powell said that the central bank's vice chair for supervision, Michael Barr, was conducting a probe into how the failure was allowed to happen and what the central bank may have missed. The question we were all asking each over that weekend was, how did this happen? Powell said. Nicholas Jasinski Powell expresses confidence in banks, sees credit tightening. Federal Reserve Chairman Jerome Powell began his post-meeting press conference by addressing what people may have been most concerned about: the recent turmoil in the U.S. banking sector.
He said emergency actions by the Fed and other regulators over the past few weeks have been effective, and that the central bank was closely monitoring the situation. He downplayed the issues as being limited to a small number of banks.
Powell emphasized that the banking system was sound and resilient, echoing language in the policy statement the Federal Open Market Committee published on Wednesday afternoon.
Later in his remarks, Powell said that it was too soon to tell how the banking stresses would affect the availability of credit in the U.S. economy, but said that it would likely be a drag on consumer spending and economic growth. The implications could be the equivalent of a rate hike or perhaps more than that, he said.
The data on the job market and inflation since the FOMC's previous meeting came in hotter than expected. As a result, Powell said, the committee had been considering larger increases in interest rates at this week's meeting and for later this year.
But because the banking turmoil is likely to result in a tightening in financial conditions, Powell said, officials settled on a quarter-point increase on Wednesday.
Nicholas Jasinski officials' median forecast for the peak Fed funds rate in 2024 is 4.3%, up from 4.1% last time the committee members gave forecasts in December. There are 4 new members of the committee since then, while Vice Chair Lael Brainard has left the Fed. The 2024 forecasts range from about 3.4% on the low end to 5.7% on the high end. For 2025, estimates of the Fed funds rate range from 2.4% to 5.7%. Their median estimate for 2025 is 3.1%, unchanged from December. Nicholas Jasinski, March 22, 2023 at 2:26 p.m. Central Bank hints, but doesn't say, end of rate hikes may be near. The Federal Reserve suggested in its post-meeting policy statement that the days of regular increases in the federal funds rate could be winding down.
For months, the Fed has included a line in its statement that its policy-making committee expected ongoing increases in the federal funds rate would be appropriate. That language, suggesting the central bank believed there were at least 2 more rate increases to come, drew outsized attention as an indication of what was coming next.
But the line was cut from the March 22 post-meeting statement. In its place, officials added phrasing noting that the Federal Open Market Committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate, the statement continues.
While Wednesday's move brought the bank's target for the federal funds rate to a range of 4.75% to 5%, the Fed's latest summary of economic projections, which was also released Wednesday, shows the median call among Fed officials is that the rate will rise to 5.1% by the end of this year.
Megan Cassella, Fed raises rates by a quarter point. The Federal Reserve raised its benchmark interest rate by a quarter of a percentage point, proceeding with its inflation-fighting efforts despite turmoil in the banking system. But a statement from the bank and officials' economic projections suggested the end of rate increases is near. The latest move lifts the target for the federal funds rate to 4.75% to 5%, marking the 9th increase in about a year. Federal Reserve officials emphasized the robustness of the U.S. banking system in their policy statement on Wednesday, but noted that the recent turmoil will likely result in a drag on the availability of credit and thereby the U.S. economy. The U.S. banking system is sound and resilient, the statement reads. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The statement didn't give many clues to the Fed's next moves, instead stressing a dependence on the incoming economic data and presumably further developments in the banking sector. Treasury's Yellen to testify to Senate about bank rescue. Jerome Powell isn't the only one speaking in Washington, D.C. today. Treasury Secretary Janet Yellen is set to appear in front of the Senate Financial Services and General Government Subcommittee at 2:30 p.m. today. The committee will discuss and review the fiscal 2024 Treasury budget. The hearing comes after the Treasury Department intervened to bail out depositors of Silicon Valley Bank and Signature Bank. Yellen's hearing will begin at the same time as Jerome Powell's news conference. She will emphasize the Treasury's work over the past 2 years, specifically its recent actions to protect depositors and extending loan facilities without hurting taxpayers, according to prepared remarks. No losses from the resolution of these banks are being borne by the taxpayer, Yellen's prepared remarks said. She testified to a House committee on Tuesday. Karishma Vanjani.
March 22, 2023 at 2:13 p.m. Stocks rise after Fed lifts rates by smaller amount. The stock market turned higher after the Fed's interest rate decision. Around 2:10 p.m., the S&P 500 was 0.3% higher, while the Dow Jones Industrial Average was up 50 points, or 0.1%. The Nasdaq Composite was up 0.6%. Follow live coverage of the stock market here. 3,936.97 calculated -65.90 -1.65% filled down pointing triangle. 11,669.96 calculated 190.15 -1.60% filled down pointing triangle. 32,030.11 calculated -530.49 -1.63%.